The S&P/ASX 200 dropped 1.5% on Monday to close at 8,505, its weakest finish in 7 weeks. The trigger was easy enough to read at the surface level. Brent crude pushed above $110 a barrel. The 12th week of U.S.-Iran conflict kept the Strait of Hormuz effectively closed, and the U.S. 10-year bond yield broke back above 4.5%, a level that in recent months has reliably dragged equities lower as it lifts the discount rate on every future earnings stream. When bond markets in Japan and the United Kingdom moved in the same direction simultaneously, the repricing became global before Sydney opened. Industrials bore the deepest damage. Brambles shed nearly 20% in a single session after management cut FY26 underlying profit growth guidance to just 3 to 5%, down from the 8 to 11% range the company reaffirmed only a few months earlier. The revision traced back to sudden bottlenecks across Brambles' U.S. subcontracted repair network in April, where warehouse automation demands have lifted pallet quality standards faster than repair capacity can follow. The company announced a fresh U.S. $400 million buyback alongside the downgrade, but the capital return was not enough to arrest the repricing of a business that markets had until Monday treated as a reliable industrial compounder. Elders fell 23% despite reporting underlying EBIT up 33% to $76.6 million for the half. Investors read through the earnings and fixated on a specific cost line: elevated diesel prices and the dual-platform expense of running legacy systems alongside a cloud migration. Higher profit, lower share price. The session made that kind of logic feel normal. Medicus defied it, climbing 2.7% to $125.39 after securing a 7-year, $90 million imaging contract with Boston-based Beth Israel Lahey Health across 14 hospitals. Santos added 2.6% as Brent hovered near $111, and the company delivered first oil from its Pica Phase 1 project in Alaska, ramping towards 80,000 barrels per day at the exact moment the market most rewards new supply. Yet none of those moves, not even Brambles' $4 billion single-day market cap erasure, produced the chart that defied easy explanation. One stock finished the session down 69%.
Tuas fell to $191 on Monday morning, wiping more than $2 billion in market capitalization within hours of the open. The stock had reported a 25.5% lift in revenue and a 500% surge in net profit after tax as recently as March. Nothing in those half-year numbers pointed at Monday's collapse. The cause arrived not from a balance sheet, but from Singapore's Infocomm Media Development Authority, which suspended its review of Tuas's proposed acquisition of rival telco M1 Limited, not because the deal economics failed, but because the regulator found evidence that Tuas' Simba mobile unit may have been operating on radio frequency bands it was never licensed to use. The gap between the financial performance and the regulatory trigger is where the capital moved. Markets were not repricing Tuas's earnings. They were repricing the probability that the M1 acquisition, which Tuas had partly funded through an ASR $435 million institutional and retail raise, can still close. The share purchase agreement carries a long stop date of 21 May 2026, meaning Tuas has 3 days to resolve a regulatory suspension that involves a potential breach of Singapore's Telecommunications Act and the conditions of Simba's facilities-based operations license. Tuas acknowledged on Monday morning that it is fully cooperating with the IMDA and that board-level review of the circumstances is underway. Neither statement is the kind of language that closes a $1.43 billion deal in 3 days. That is the mechanism. But the mechanism is not the deepest part of this. Tuas was built around David Teo, the founder and former CEO of TPG Telecom, who has spent decades constructing telco challengers by undercutting incumbents on price and then monetizing scale. The M1 acquisition was the step that would have transformed Simba from a fast-growing digital disruptor into a full-service Singapore carrier. If the merger collapses, either because the long stop date expires or because IMDA imposes penalties severe enough to alter deal terms, Tuas reverts to being a high-growth but subscale challenger competing against the combined infrastructure of the entities it was trying to consolidate. The ASR $435 million raised from investors was not raised to fund that scenario. What the 69% decline does not yet confirm is whether the spectrum usage was deliberate, inadvertent, or a classification dispute over band boundaries. The distinction matters for penalty severity, and penalty severity is one of the 2 live variables the M1 counterparties and IMDA are evaluating simultaneously before 21 May.
The unresolved question from Monday's collapse is whether the Tuas story is a timing problem or a structural problem, and the answer hinges on what the IMDA investigation surfaces before the long stop date.
The most favorable scenario for Tuas shareholders involves the regulator treating the spectrum usage as a technical classification error rather than a willful breach, accepting Simba's cooperation and lifting the suspension in time for the deal to proceed under modified conditions. There is a precedent framework for this. Singapore has historically applied proportionate penalties to telcos for license condition breaches, particularly when the operator cooperates early and demonstrates remediation. Under that path, the 69% drop becomes the kind of regulatory risk overshoot that occasionally appears in small telco markets, severe on announcement day, recoverable once the specific penalty range is known. The more damaging scenario involves a determination that the spectrum usage was sustained and knowing, triggering penalties under the Telecommunications Act that include potential license conditions, financial penalties, or deal conditions that neither Tuas nor M1 can accept inside the remaining 3 days. In that case, the long stop date expires, the acquisition falls away, and Tuas shareholders are left holding a Singapore challenger telco that raised $435 million for a deal that no longer exists. That capital is not automatically returned. It was raised as equity, not escrow. The verification benchmark the market will watch is simple. Any IMDA statement before 21st May that characterizes the spectrum issue as technical rather than intentional would shift the probability distribution sharply toward deal continuation. Conversely, silence past the long stop date implies collapse. The lean here sits toward continued pressure on Tuas in the near term. 3 days is not enough time to fully resolve a regulatory investigation of this kind, and the long stop date structure puts the burden of resolution entirely on Tuas rather than on the deal's counterparties. But the magnitude of Monday's move already prices a high probability of deal failure. If the IMDA determination comes in lighter than the worst-case read, the recovery from 191 could be as sharp as the fall. What would prove the bearish lean wrong is a statement from the regulator before Wednesday that uses the word inadvertent. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.